Hi guys, for this video lesson, we're going to discuss stocks and bonds under your general mathematics from quarter 2, module 8. I'm your subject teacher, Arvin S. Enriquez. Our lesson objectives. At the end of this video lesson, you are expected to illustrate stocks and bonds, distinguish between stocks and bonds. So let's go now with your stocks and bonds. So let's say that it's time to invest your money. So how exactly are you going to allocate that money? When and where you can invest your money? So after all, a well-diversified portfolio strategy is recommended before you start to buy assets such as stocks and bonds. Indeed, stocks and bonds are two of the most traded types of assets because you can buy and sell. So each available for sale on several different platforms or through variety of markets or broker. So it can be online or in person. So here we go over the primary differences between stocks and bonds. So entirely our discussion for this video lesson, it's all about the definition of your stocks and bonds and what will be the difference between these stocks and bonds and which is better. No, if we try to compare your stocks to bonds, which is better between your stocks and bonds? So let's deal now with this what's new. So read carefully the lyrics of the song. You may sing the song in the tune of Row, Row, Row Your Boat to emphasize how people can save with stocks and bonds. So here is the song. So stocks are shares that pays dividend, meaning to say that there is a dividend in your stocks. Gradually, investing, then you can earn. Wherein in your stocks, you can earn also. So stocks, they change. The price goes low or high. So there is a change with the price of your stocks. Gradually, money goes round and round because the price can go low or high. So bonds are loans that pays an interest. So your bonds is a loan, meaning to say that a bonds it is more secured. Your money is more secure, no? Secured with your bonds. So gradually, growing while you wait. So that will be your bonds. So there, if in terms of security, it is more secured, no, in dealing with your bonds to your stocks because the price of your stocks can go low or high eventually, or it can be from time to time can goes low or high. It depends on the situation or scenario in the stock exchange. But there is a security in your bonds because these are loans. Meaning say even if the price goes low or high, still there is a security. No, these are questions to ponder. So based on the given song, can you define stocks? How about bonds? Number two, can you distinguish the difference between stocks and bonds? Number three, between stocks and bonds, which do you prepare to invest your money and why? Which is better now between your stocks and bonds? Now, what is it? So let's go now with your stocks and bonds. Let's go more about your stocks and bonds. So we consider that your stocks are and bonds are the heartbeat of the economy. So much of the world's business activity would be impossible without stocks and bonds. But whether you trade on the Philippine Stock Exchange, financial terms can always be confusing. That's why it's better for you before you invest your money, know first the difference between your stocks and bonds and which is better between your stocks and bonds. So before you invest in a stocks or a bond, no, you need to know what is the difference and which one should you choose. So because investing is like giving no your efforts, no, because earning this money is not so easy. So you give your efforts, you give your time, no, and commitment for you to earn money. That's why if you decided to buy a stock or a bond, you need to know first what is the difference and which is better, no, between your stocks and bonds. Now, your stocks and bonds are certificates that are sold to raise money for starting a new company or for expanding an existing company. So there are two reasons why we buy stocks and bonds, no? Buy and sell of your stocks and bonds. First is to start a new company, and second for the expansion of an existing company. So there are companies wherein they decided to buy stocks and bonds because they want to expand their existing company. They want to open other branches, no, in different places. For example, around the Philippines. So stocks are and bonds are also called securities. But between your stocks and bonds, which of the two we can say that it is more secured, no? That our money is more secured, or our money are more secured, no? Wherein if we invest on stocks and bonds, which of the two we can say that there is a more security, what we call security, no? And people who buy them are called investors. So please do take note of that people who buy stocks and bonds are called investors. But for me, no, bonds are safer for a reason compared to stocks. Why? Because you can expect a lower return on your investment, but since bonds are loans, we consider that these bonds are loans, meaning say that there is more security, what we call security, compared to your stocks. Stocks, on the other hand, typically combine a certain amount of unpredictability in the short term with the potential, no, for a better return on your investment. That's why it is more secured dealing with bonds compared to stocks. So let's deal now with your bonds. Sometimes companies raise money by selling bonds instead of stocks. Yes, it is because it is more secured dealing with your bonds compared to your stock. When you buy a stock, you become a part owner in the company. Yes, it is because you are buying a portion of that company. That's why you're a part owner in the company. So to raise money, companies may not want to sell more stocks and thus dilute the ownership of their current stock owners. So they sell bonds. So a bond now is a form of long-term investment. So it can be a loan issued by a corporation or government where the purchaser becomes a creditor of the company. So it represents a promise from the company to pay the face amount to the bond owner 7 at a future date. So along with interest payments at a stated rate. So there's a defined interest of payment and the future date or the maturity date wherein the company are obliged to pay, no, the loans that they decided to borrow from a corporation or a government agency. So the company, state, or municipality that issues the bond is called the issuer. So you need to take note of that. Again, the company, state, or municipality that issues the bond is called the issuer. The annual interest paid by the issuer to the lender or the bondholder. So there are two terms here, or we can use substitute no your bondholder as a term that we can use as substitute to your lender. So it's called a bondholder. On the bond is referred to as the coupon. So the annual interest paid by the issuer to the lender. So these are coupon. So the coupon rate is the annual payout as percentage of the bond's par value. So bonds have two kinds of values. So these are par value and market value. So let's go now with the what is the difference? No, what is the deep definition of your of the two kinds of these two values of a bonds? So a par value of the bond is the same as its face value, while the market value of a bond is the price at which the bond is being sold. So meaning to say, whatever the price at the present of this bond, so that will be the market value. So it may be greater, no, than or less than the amount of the par value. But most of the time, the market value is greater than the par value. If the market value is greater than the par value, then the bond is selling at a premium. So you need to take note of that. No? There's a scenario here wherein if the market value is greater than the par value, the bond is selling at a premium. Now, if the market value is less than the par value, then the bond is selling at a discount. But most of the time, again, I said before that most of the time, the market value of a bond is greater than the par value. Meaning to say, most of the bond no, are sell or sold at a premium. Now, let's go now with Now I Know. Investors are always told to diversify their portfolios between stocks and bonds. But what's the difference between the two types of investments? Here's a look at the difference between stocks and bonds on the most fundamental level. So here, under your second column, this will be all about your stocks. And for the third column, it's all about your bonds. So by definition, first, let's start with the definition. So it's all about the comparison, no? The basic comparison between your stocks and bonds. So for the definition, a stocks is a form of equity instrument or raising money by allowing investors to be a part owners of the company. What is important about your stocks, they allow new investors to be a part owners of a company. So that's why it is a raising money, no? It's a form of equity instrument or raising money because they allow new investors to be a part, no? To be part owners, I mean, of the company. So that's the concept of your stocks. They allow new investors to be part owners of the company because they want to raise money from these new investors. Because they decided to, for example, an expansion of a company or they want to build a new company which is sister company of the existing company. Now, for the bonds, no, it's a form of a debt instrument or raising a money by borrowing from investors. That's why it is a debt instrument with a promise, no, to pay back the money with interest. That's why I always said that it is more secure, no, secure to deal with bonds compared to your stocks because there is a promise, no, to pay back the money with interest, and there is a return or a guarantee, no, that your money can. So the return of guarantee, there is a return of guarantee in your bonds. That's why it is more secured, no, dealing with your bonds compared to your stocks. Now, in the issuers, no, for the stock, it is the corporates, while in the bonds, it is the government institution, financial institution, and companies, and etc. That's why it is more secured, no, because these are government institution. There is no such thing that a government institution declare, no, a bankruptcy. So there is an stable funds for that, meaning to say whether the price of these bonds go high or low, there is a security, what we call security in the money that you invest or in the money that you invest to that particular bonds. No. Status of holders. Shareholders are the owners of the company. So that will be your stocks. Now, in the bonds, bondholders are the lenders to the company. So they are the one, no, who provides money. They are the one who makes the fund available for the borrower. Now, for the form of returns, profits earned by the company are paid in the form of dividends. Yes, it is, no? But again, interest payments are made in the form of coupon payments. If the return in the stock is uh, by dividend, now in your bonds, the return is by interest. So there should be an interest in your bonds. Now, in the risk level, no, it is more risky dealing with your stocks compared to your bonds. Why? Because the high since it depends upon the performance of the issuer. So no guaranteed returns. Yes, it is, no? Because if there are lapses, no, in a way that your issuer, no, if there's a lapses in the performance of the issuer, if they declare a bankruptcy, then there is no return of investment under your stocks. Now, while in your bonds, relatively relatively low. Why? Because since bondholders are prioritized for repayments. So there is a guarantee that there is a return of investment in your bonds. No? Major risks associated. Market risk and business risk. Yes, it is, no? Because from time to time, it's just like a way there's a low and high value of your stocks. That's why it is more risky dealing with your stocks. Now, with your bonds, interest rate risk, inflation rate, or inflation risk, no? So it can be low or high, but again, it is more secure dealing with your bonds compared to your stocks. Now, additional benefits. In your stock, shareholders get the right to vote. Yes, they have the power to vote. They have the power to say what they want, no, for the company on how they will go with this company or business. Now, with the bonds, bondholders get the preference in terms of repayment and also on liquidation. So it is more transparent. It's more transparent, no, compared to your stocks because bondholders get the preference in terms of the repayment and also on liquidation. Now, for the market value, for the stocks, when interest rates have fallen significantly, the market stock value rises. Yes, it is, no? Now, while in your bonds, when market interest rate decrease, the market value of an existing bond increases. So that is the difference no between the concept of your stocks and bonds. Now, in your stocks, no, again there is a voting rights in the company with your shareholders, while in your bonds, no, that is an additional benefits, preferential treatment when bonds matures. So that's why bondholders get the preference in terms of repayment and also on liquidation. Now it's more clear, no, clearer to us, no, what is the difference between your stocks and bond, and which is better, and which is between your two, between the two, which is more secured dealing with, no. And again, for me, it's more secure, no. Bonds are safer for a reason. But again, as an investor or investors, it depends on you. Which of the two are you going to choose? So for the activity, you can write this one in your Caldea notebook, and you're going to pass this on a set deadline. So suppose you have savings in the bank that you want to invest in stocks and bonds instead of setting up in a new business. Write 1 to 2 paragraphs discussing what method you can use to make the investment and explain the reason for your decision. So you're going to side or you're going to design no a new setup no or in a new business that you want to deal with. Now with the content area rubrics, so we're going to use these rubrics in grading your outputs. So there's a 3, 2, 1 here. There's a corresponding descriptions wherein you can earn no your points. So it's more easy for us because there's a description here, or you can see, what will be or what are the things that you need to attain with this activity. So thanks for watching. So please like and comment and subscribe.